Around 4 or 5 years ago, if someone had asked you which company would dominate India's two-wheeler electric market, most people would have said Ola Electric. And rightly so. That time, Ola had all the ingredients: aggressive marketing, record-breaking bookings, massive funding, and a charismatic leader. Ola was in news headline all the time. On the other hand, there was another company called Ather Energy. No flashy advertisement, no grand promises, no social media hype. It simply kept doing one thing: building better products and improving execution. I still remember discussing it last year during its IPO. It was a loss-making company and nobody was interested in it. In fact, there were many negative comments saying that stock is very expensive. Fast forward today, the story looks very different. While Ola has struggled with market share, customer complaint and execution challenges, Ather has strengthened its position in Indian two-wheeler EV market. In fact, Ather now holds around 16-17% share in Indian two-wheeler EV segment. It has narrowed down its losses significantly and stock price has been rewarded with nearly 4 times jump from IPO price. In fact, company has recently declared its Q1 result and its sales have jumped 88% year-on-year and EBITDA margin have turned positive for first time against minus 16% in Q1 last year. So in this video, we'll revisit Ather journey so far, its business model, the EV opportunity, company's growth plan, along with key risks. The idea is to understand the growth potential in Ather and whether it makes sense to invest at current levels or not. But before we get started, a quick disclaimer. As always, this video is not a buy or sell recommendation. If you are here only for stock tip, you can skip this video. The idea is to understand the business, evaluate the risk, assess the valuation, and then let you decide whether it deserves a place in your portfolio or not. Alright, let's get started. So Ather was founded in 2013 by two IIT Madras graduates, Tarun Mehta and Swapnil Jain. At a time when most people believed electric scooter in India would remain a niche product, these founders had a different vision. They did not want to just build another scooter. They wanted to build a smart scooter where hardware and software work together, like a smartphone on two wheels. After spending nearly 5 years on research and product development, Ather launched its first scooter, Ather 450, in 2018. Unlike many EV startups that focused only on selling vehicle, Ather realized that customers would hesitate to buy an electric scooter if charging remained a problem. So instead of waiting for someone else to build the ecosystem, company started investing in its own fast charging network called Ather Grid. Over the years, it has also built its own software platform, mobile app, and connected vehicle ecosystem. This brings us to Ather's business model. At first glance, it may look like Ather is simply selling electric scooters. But in reality, it is trying to build an entire EV ecosystem. The biggest source of company's revenue is of course the sale of electric scooter. Today, its product portfolio includes the performance-focused 450 series and family-oriented Rizza, which has helped company expand beyond premium buyers into much larger family scooter segment. In fact, Rizza has become one of Ather's biggest growth driver over last year. But the scooter is only the starting point. Every Ather scooter comes with its own software platform that enables features like navigation, ride analytics, over-the-air software update, theft alert, and various other connected features. This makes the ownership experience very different from a conventional two-wheeler and also helps the company build a long-term relationship with customers. Then comes the charging ecosystem. Through Ather Grid, company has created one of India's largest public fast charging network for electric two-wheeler. This not only improves customer convenience but also strengthens the Ather ecosystem and increases customer stickiness. In addition, Ather also earns revenue from accessories, extended warranty plan, after-sales service, and other ownership-related offering. As its install base of scooter grows, these high-margin revenue streams are expected to become increasingly important over time. There's another thing that stood out for me while studying the company. Ather is probably one of the most R&D focused companies in Indian two-wheeler industry. Since inception, company has filed 463 patents, out of which 283 patents were filed in FY26 alone. That tells you the pace at which company is innovating. Their R&D is not just limited to designing new scooter. Company is working on battery technology, motors, softwares, vehicle electronics, charging solution, and manufacturing processes. In other words, Ather is trying to build a lot of its core technology in-house rather than depending entirely on supplier. Personally, I think this focus on engineering and product development has been one of Ather's biggest strengths over the years. So if I have to summarize Ather's business model, I would say that Ather is not trying to become just another scooter manufacturer. It is trying to build an integrated EV ecosystem where the vehicle, software, charging infra, and customer experience reinforce each other. And that integrated approach is one of the biggest reasons why company has been able to steadily improve its competitive position despite operating in a highly competitive market. Now question is, how big is the opportunity for Ather? Let's discuss it. Now even if Ather execute brilliantly, the investment case ultimately depends on one simple question. Is the electric two-wheeler market in India large enough to support years of growth? And the answer depends on how quickly India transitioned from petrol scooter to electric scooter. So India is world's largest two-wheeler market with annual sales of around 18 to 20 million vehicles. Out of this, scooters account for roughly 35 to 40% of total sale. So even a gradual shift towards electric scooter could create a massive opportunity. The good news is that this transition has already started. Just 5 years ago, electric two-wheeler were almost invisible, contributing less than 1% of industry sale. Today, EV penetration in scooter has already crossed 20% in many months, and the number continue to increase as battery prices fall, charging infra improves, and consumer become more and more comfortable with EVs. The economics have also become much more attractive. Although an electric scooter may still cost slightly more upfront, the running cost is much lower. Charging an EV scooter typically costs only a fraction of what you would spend on petrol for the same distance. On top of that, electric vehicles have fewer moving parts that leads to lower maintenance cost over the lifetime. It means that for someone who rides, let's say 30 to 40 km every day, the total cost of ownership becomes much lower than petrol scooter. The government policies have also played an important role in accelerating the adoption of electric two-wheeler. Many state governments continue to support EV adoption through incentives, lower road taxes, and investment in charging infra. More importantly, EV adoption is increasingly being driven by economics rather than subsidies alone. That said, it's important to understand that this transition will not happen overnight. India still has millions of consumers living in small towns where charging infrastructure is limited. Many buyers also remain concerned about the battery life, resale value, and charging convenience. So the shift towards electric mobility is likely to be gradual rather than exponential. But that is perfectly fine. For companies like Ather, they don't need India to become 100% electric. Even if EV penetration increases from current levels to 40-50% over the next decade, the addressable market would become significantly larger than what it is today. So the opportunity is huge. The challenge is capturing it profitably. Now, next question we need to understand is how Ather is planning to capture this EV opportunity. Let's discuss it. So in my view, company's strategy rests on 5 key pillars. The first pillar is expanding the product portfolio. For several years, Ather was known mainly for its 450 series scooter. These products helped establish the brand as a premium technology player, but they catered to a relatively small segment of customer. The next phase of growth came with launch of Rizza. Unlike sporty 450 series, Rizza was designed for families. Since family scooters form the largest segment of Indian scooter market, this launch significantly expanded Ather's addressable market. Today, Rizza contributes more than 60% of Ather's overall sale. But the company is not stopping there. Management is now working on a new modular architecture called the EL platform. Now, why is this important? Because today, a large part of India's scooter market lies in 1 lakh to 1.25 lakh price segment. This is where the highest volumes are generated, but Ather has limited presence so far. So Ather EL platform is designed to change that. By using a modular architecture, Ather can launch multiple scooter models across different price points while sharing common components. This reduces the development cost, improves manufacturing efficiency, and allows company to address a much larger customer base. In other words, if 450 series established Ather's premium brand, Rizza expanded its customer base, this EL platform could become the company's biggest growth engine by helping it compete in the high volume mass market segment. Then company's second pillar is rapid retail expansion. Ather has expanded its experience center network to more than 700 stores, almost doubling its footprint over the last year. Company is also moving beyond its traditional stronghold in South India and aggressively expanding across Northwest and Central India. This geographical diversification should open up a much larger customer base over the next few years. Then the third pillar is building a complete EV ecosystem. Unlike many manufacturers that simply sell vehicles, Ather has invested heavily in creating an integrated ecosystem across its scooter. It operates one of India's largest fast charging network for electric two-wheeler with over 6,000 Ather grids charging points across more than 500 cities. Apart from this, company also earn recurring revenue through software subscription like your Ather Connect and Ather Pro. These recurring revenue may be small today, but over time, they can become a high margin business that complements vehicle sale. Then company's fourth pillar is scaling manufacturing while improving profitability. To support future demand, Ather is expanding beyond its Hosur manufacturing facility by setting up a new manufacturing plant in Maharashtra. At the same time, company continue to increase localization by developing battery packs, motors and software in-house wherever possible. And also, company started taking steps towards international expansion. While exports are currently a very small part of business, markets like Nepal, Sri Lanka could provide an additional growth over long term before Ather actually expand into various other international markets. So if I had to summarize Ather's strategy, it would be expand customer base through new product, increase reach through retail expansion, build customer stickiness through software and charging infra, and gradually improve profitability through scale and localization. If company can execute well across these 4-5 pillars, it should be well placed to capture a meaningful share of India's growing EV opportunity. Now that you understand the opportunity, let's also understand the key risk that you must keep in mind. So first and probably the biggest risk is intense competition. Unlike a few years ago, Ather is no longer competing only with startups. Today, almost every major two-wheeler manufacturer has entered into this EV space. Companies like TVS, Bajaj, Hero Moto and Honda have deep pockets, extensive dealer network and decades of manufacturing experience. Many of these companies can afford to sacrifice margins in the short term to gain market share. At the same time, startups like Ola Electric continue to compete aggressively on pricing and new product launches. This means Ather cannot afford to slow down. It must continue innovating, launching new products and expanding its distribution network while also improving profitability. Then second risk is slower than expected EV adoption. While the long-term direction is clearly towards electrification, the pace of adoption remains uncertain. Charging infrastructure is still evolving and many customers continue to worry about battery life and resale value. If EV adoption grows slower than expected, companies like Ather may also see slower revenue growth than what actually the investors are anticipating. Then third risk is execution risk. Ather has ambitious plan, expanding retail stores, increasing manufacturing capacity, launching new products, entering new geographies. Executing all this simultaneously is not easy. Any delays in product launch, supply chain disruption or operational challenges could impact companies' growth and profitability. Then fourth risk is commodity price inflation and supply chain disruption. Manufacturing an electric scooter requires various raw materials like lithium, nickel, copper, aluminium and rare earth elements. In recent years, global geopolitical tensions and supply chain disruptions have shown how quickly the price of these commodities can become volatile. So if raw material prices rise sharply, Ather may not always be able to pass on the entire increase to customer, especially in a highly competitive market. This could put pressure on gross margin and delay companies' path towards sustained profitability. Now that we have discussed both opportunity and risk, let's finally look at whether Ather is still worth investing or not. Today, the most important question is, even if Ather is executing well, does the stock still offer an attractive investment opportunity at current levels or not? To answer that, let's first look at how the business has performed financially. So over the few years, company's revenue growth has been simply exponential. All the company was in losses, but the losses have now narrowed down. In latest Q1 result, company's revenue grew by 88-89% year on year. More importantly, Ather has now achieved a major milestone by reporting a positive EBITDA margin compared to a negative margin of around 16% in same quarter last year. This is significant because it indicates that company is gradually benefiting from operating leverage. As production volume increase and localization improve, the cost per vehicle starts declining, making the path towards sustainable profitability much more visible. However, when it comes to valuation, we can't use traditional PE ratio metric because Ather is still loss-making. But at the same time, this is also growing at a fast rate. Then if you look at price to sale, it is certainly not cheap. In fact, the valuations are premium. So how do you really assess the right valuation? Honestly speaking, it's tricky. Now recently, Ather has raised 1300 crore through a QIP at an issue price of around 1200 rupee and include reputed institutions in the QIP. In fact, this QIP was subscribed more than 8 times. There's also a 1200 crore preferential issue to strengthen company's balance sheet. So total capital infusion is 2500 crore. Interestingly, Hiromoto, that is the largest shareholder in the company with around 30% stake, also participated in QIP and committed 1000 crore out of 2500 crore capital infusion. While QIP price should not be viewed as an intrinsic value of the company, it does indicate that long-term institutional investors were comfortable investing in Ather at around 1200 rupees level after carrying out their due diligence. So that would give you a good idea. However, you need to understand that the market is no longer valuing Ather as a loss-making startup. Instead, it is already a 50,000 crore market cap company and current valuation is based on the expectation that company would continue to grow at a faster rate. So if Ather continues gaining market share, successfully launches products on its new EL platform, expands its retail network and steadily improves profitability, company could justify its premium valuation over time. But if growth slows, margin disappoint or competition intensify, stock price could witness correction even if the underlying business remains healthy. So rather than asking whether Ather is cheap or expensive, I think the right question is, can Ather grow fast enough over the next few years to justify the expectation already built into the current stock price? Personally, I believe Ather has built a strong brand, a differentiated product ecosystem, and a credible management team. The long-term opportunity is certainly attractive. However, after the sharp rally from IPO price, it is now a business where execution will have to remain consistently strong for many years to justify the market cap it commands today. For now, I believe Ather has all the ingredients to grow consistently at a faster rate. So considering the tailwind and the company's growth plan, I believe Ather should continue to reward shareholders in the coming quarters. Not explosive, but still a decent return potential. But of course, ultimately, it's your money. So you need to decide if it is worth investing at current level or not. So make sure that you understand the business properly and invest only if you have built the conviction. Well, let me not stress this video further. Now tell me in the comment, is it worth investing in Ather at current levels or not? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.